Hey, what's up, stock compounders? Brad here. So recently, Tim Ferriss interviewed Ed Thorp. Now, I love Ed Thorp. When I read A Man for All Markets, his story is so fascinating to me, right? Starting off as a mathematics PhD, really in that world of academia, but this unquenchable thirst to solve problems in the real world, not just in theory through school. So he decided to go after Vegas. All right, I'm sure many of you are familiar with his story. But before computers were even really a thing, Ed Thorp came up with a system for 21 to beat blackjack. And then he came up with a system with another professor to beat roulette. And then, with all the money from winning at the casinos and book royalties, he decided to go into the world of investing, to tackle Wall Street. So this is a fascinating interview, an hour and a half. Tim Ferriss, Ed Thorp. I'm going to share kind of my highlights from this interview. It may be a little bit long, but there is so much in here. I have 6 pages of notes. I highly encourage each of you to go through and watch this whole video and then watch this, sort of my summary of kind of the biggest takeaways, what I took away. So let's get right into it. As I said before, PhD in mathematics. He used computers at MIT to refine his blackjack strategy in 1959. Effectively, he had to teach himself how to program, okay, in order to test and improve this system that he had devised for beating blackjack. He also wanted to publish that system so nobody else would take the credit. So came up with a system, had to actually test it in Vegas to make sure that it worked. Because the system, in theory, it's not good enough. You need to actually test it in the casinos. So he did that, and his starting capital was $10,000 during a weekend where he was testing this strategy, and he walked away with $21,000. So he just more than doubled his money. And in today's dollars, it's like an order of magnitude greater. So, he basically made over $100,000 in today's dollars in one weekend. He says a lot of things seem to work in theory, but when you actually try to do them, you find all sorts of things you didn't think of. Okay, so that's really taking this academic theory and putting it to the test in the casino. And then roulette, right? So after he conquered blackjack, published the book, the casinos started to change the rules for blackjack. Kind of the perpetual shuffling of multiple decks made it much harder to beat blackjack. But he decided to take on roulette, right? Who's going to take on roulette? It almost seems ridiculous to take on a game like roulette. It just seems so random where that ball is going to end up on the wheel. But what he did was with another professor at the university that he was teaching at, they built the first wearable computer. Okay, a computer with 11 or 12 transistors. And there were 2 people. So at the roulette wheel, there's one people that's placing the bet, one person that's placing the bet. Another person is entering information into the computer about the position and the velocity of the ball and information about the rotating wheel. So the computer would instantly tell the user where to bet. Okay, and there would be a tone in the ear of the bettor, and that last tone would tell the bettor which section of the roulette wheel to bet on. It would be a section of 5 neighboring numbers on the roulette wheel. And this system had an edge of 44%, okay, massive edge of 44% over the casino. Ed Thorp says, I'm curious and always looking for things to understand. Okay. One of the hallmarks of a great investor is this insatiable curiosity, wanting to tackle new problems. I really like this. This is something I need to write on my wall. If you tell yourself, I'm not going to do this because I can't do the whole program, that's a big mistake. Just start doing it. That applies to so many things in life. It's really the essence of compounding. Taking one small step each day to the point where you can actually commit to it over the long term. And those small steps can compound. They can add up in incredible ways. But you need to take that first small step. You can't get overwhelmed looking at the whole program, right? Looking at the end game and not getting started. He says, the way I got into finance and investing was I made money at blackjack and from book royalties, so I had spare money for the first time. Right before that, Ed Thorp was just living paycheck to paycheck. I wanted to figure out what to do with it, so investing made good sense to me. Put some capital aside, let it grow. Right, that was the objective. He started by making a lot of foolish beginner mistakes. Right, a lot of the same mistakes we see as markets get frothy. Right, and beginners really pour into the markets thinking, this is easy money. Many mistakes tend to be made in that kind of frothy environment that we've had over the last couple of years. Then I decided to sit down and really figure this thing out. Spent the summer of 1964 reading in a big bookstore in Beverly Hills. Read all the investment books and newspapers they had. Okay, so again, he's a professor, has the summers off. Spent the whole summer, 1964. Again, in the summer of 1965, reading whatever he could find. So he basically spent 2 whole summers reading everything he could find on investing. Now, in that second summer, he happened to get a little book on warrants, common stock purchase warrants. These are the forerunner to what people call call options now. And what he realized is that he could figure out how to value these things mathematically, these warrants. He says, if I did that, I'd probably be ahead of the crowd who didn't know how to do these things. So I'd probably have an edge. So this is really Ed Thorp's entry point into investing, into starting his own hedge fund, finding an inefficiency in the market where people don't really know how to value a particular asset, these warrants. I began to do warrant hedges. Okay, there's 2 ways that Ed Thorp talks about doing a warrant hedge. One is to buy a cheap warrant and to short common stock against it. The other is to short an overpriced warrant and buy common stock against it. So as he was learning about warrants, it turned out he met another professor at UC Irvine who had an elementary model for pricing warrants. Okay, so the thing Ed Thorp was setting out to do, this guy had already done it. Right, he'd come up with an elementary model for how to price these things, and together they wrote a book called Beat the Market. And what he discovered, he could make a steady 25% per year with practically no risk through these warrant hedges, which is incredible, right? That's nirvana for an investor, a steady 25% per year. Now, the dean of the graduate division at UC Irvine happened to be an investor with Warren Buffett, right? So Ed Thorp, very early on, came across this guy, Warren Buffett. He says, after meeting Warren Buffett, I thought this is going to be the richest man in the world. He got the idea of forming a hedge fund from Warren Buffett, who was closing down his partnership in the late 1960s. The private limited partnership ran for 20 years. This is Thorp's private limited partnership. ran for 20 years, used ideas that he kept generating, mathematical finance ideas, to keep staying ahead of other investors and generating excess returns. In 20 years, we had only 3 down months. Okay, not 3 down years, 3 down months in 20 years. And those down months were down less than 1%. They were basically printing money every month, made just under 20% annualized. So you've got an extremely low risk and very high return situation. Again, nirvana for an investor. I figured out what this model was in the middle of 1967. This was the model for how to value these warrants. I decided I would just use it for myself. Now, Black and Scholes also read Beat the Market, the book that Thorp published with this other professor. Now, after reading that, there were clues about how to price warrants in this book, Beat the Market. They made a mathematical finance model to value warrants and options very accurately. Black and Scholes did. Thorp's model was based on a set of assumptions, okay, that were pretty good, right? They worked very well. But Black and Scholes, did a better job on the model than Thorp did. They had very tight mathematics behind their derivation. So when the Chicago Board of Options Exchange opened in 1973, Thorp thought, he was going to have free reign with these warrants. But Black and Scholes published their model. And so Thorp was quite concerned, right? Fortunately, people didn't catch on right away. So Thorp cleaned up, all right? It was not an efficient market with warrants. And Thorp was really able to take advantage of that. And of course, Black and Scholes were the one who published the model. So they got the credit, but Thorp got the cash, right? He got the capital because, he kept this thing kind of to himself. It wasn't exactly the same as what Black and Scholes figured out. And the rest of the market hadn't figured it out yet. Even though this thing was published and out there, it took a while for people to really catch up. And by the time they did, Thorp had was solving tangential problems and still able to find market inefficiencies that he could capitalize on with his hedge fund. Tim Ferriss asks, why did you think Buffett would be the richest man in the world after you met him? So here's what Thorp's response was. I saw that he was compounding at a high rate of return, that he'd been doing it for a long time. He was very, very smart, and he knew a tremendous amount about companies, right? He was just a great evaluator of companies. And Buffett was generating 30% before fees from 1956 to 1968 during those limited partnership years. Thorp says, I was sorry he was going out of business. Turned out he wasn't. He was just kind of moving things over to Berkshire Hathaway. Decided to make a poor textile company his own little mutual fund. And he didn't particularly encourage his exiting partners to take the shares in that company because he wanted them for himself. This is Buffett. Not knowing what to do, many of them just took the cash and exited. It's really interesting to go back and read, those final letters to investors in Buffett's limited partnership. It's true. He didn't particularly encourage his investors to, just come over to Berkshire Hathaway. Perhaps Buffett wasn't sure what he was going to do with it yet. I don't know that it was purely a selfish move, that he wanted to kind of soak up all the shares for himself. But and then Thorp says, I lost track of him, figuring he was just working for his own account and there was no opportunity for an investor to kind of tag along with Warren Buffett anymore. But in 1982, I happened to see an article about Berkshire Hathaway and saw that Buffett was running it. It had gone from $12 per share, I think in the late 1960s, to $982 per share. Okay, so what is that, like an 80 bagger or something like that? So Thorp thought to himself, okay, I missed out on quite a run there, but is there still an opportunity? Most investors might have looked at that and thought, oh man, I missed it. It's gone from 12 to 982. Clearly it's, I've missed that boat. Thorp, on the other hand, thought, I know what he's doing. I know this man. I know what he's going to do. I'm buying at 982. So even though he missed that 12 to 982, buying at 982 turned out to be a pretty good move, right? From 982 today, it's over $400,000 per share. So more than a 400x increase from when Thorp bought in. What would you teach today in an investment seminar? A question to Ed Thorp. The first thing I would tell them is the answer is really easy for almost everybody, but you're not going to believe me until you work through it yourself and understand it. And I really like that point. It's easy to just tell everyone to, dollar cost average into an index fund, like the S&P 500. But for a lot of investors, that's much easier said than done. They actually need to understand why that's the best thing to do by trying other things. Thorp says, if you're a long-term investor, you should just buy and hold equities. The best place to have bought and held equities has been the U.S. for the last couple hundred years, 200 years. Equities have compounded at 10 to 10.5% over the last 200 years. Now, the kind of work you have to put in to do much better than the market is substantial, okay? It's not like you can find a little hack to outperform the market, at least from Ed Thorp's perspective. It doesn't seem like it at first, but when you get into it, there are all kinds of details and follow-ups and things to be checked out. You end up spending a substantial amount of time and energy figuring out how to do it better. And of course, for everyone that finds out how to do it better, the rest of the crowd that isn't buying the index is doing a little bit worse. If you're really interested in investing, it's worth educating yourself and trying to do it because you will learn a lot about investing. You'll learn a lot about how the world works and a lot about life too. Okay, so there's a lot of lessons. There's a lot to be gained from trying, right? From trying to figure it out for yourself, how to beat the market, how to invest by picking stocks or, whatever asset kind of suits your interest. But, I guess the big takeaway here is make sure, do that, but be honest with yourself, okay? Are you actually outperforming or are you underperforming by trying this active approach? And if you're underperforming, the rational thing to do is to look at yourself and say, okay, I'm not beating the market, right? So I should probably join the market. But it was a worthwhile exercise to try to beat the market because, one, I don't have to question anymore whether or not I can beat the market. I know, which makes it a lot easier to invest intelligently from here on out. Let's see. If you're 89, how can you be a long-term thinker? I like that question. This guy's 89. You look at him. I mean, Tim Ferriss said himself, he looks like he's in his 60s. It's incredible that he's, 2 years younger than Buffett, I think. And he looks, 10 or 20 years younger than Buffett, in my opinion. But I like this answer. How can you be a long-term thinker if you're 89, or a long-term investor? Well, I have children and grandchildren, right? So it's multi-generational thinking, not just thinking in your own short lifespan. Imagine how the world would change, how the world would be different if everyone was able to think beyond their own lives. There'd be a lot more compounders out there, right? The runways would get a lot longer in terms of investing and decision making. Okay, there's a few more nuggets I want to cover here. There's some good stuff about mental models. I'm not going to get into those here. One of the resources for mental models, Elon Musk's 50 Cognitive Biases. Inc. put out something on that. Looked pretty good. So check that out if you want like a quick list of mental models to chew on. Now, he's asked, where do you invest today? Okay. What investors do you like in terms of giving them your money to manage? Ed Thorp's response, I don't have anybody now that I'd give money to invest. Okay. That's a big statement. I mean, this guy, he's got so many connections in the investment world. And he's saying, I don't have anybody I want to give money to. Okay. I don't think any of them are going to do better for me than the market is going to do. So that's a big statement. He says there are a few good hedge funds around, but they take too much for the general partner and leave too little for the limited partner. Okay, the fees are just too high. They also generate income that is highly taxed if you're a taxable investor. So they're really only good for nonprofits. He's asked, what past investors would you have given money to? Obviously, Buffett is one answer. He says, I did give money to Ken Griffin's Citadel. He was outside investor number 1 in Citadel. He said he exited recently because the taxes take too big of a bite. And he just ends up better off with an index fund. He says, the way I got into the investment world, I was an academic and I was curious and I found things interesting, right? There were interesting problems to solve in the investing world. I wasn't really interested in getting rich. I wasn't in there to get rich. I was in there to deal with interesting math problems that kept coming up. Okay, so just a very different approach to the vast majority of people who enter the investing arena. Again, lots of people in the investment world go into it for the money. When they do, they keep going and going and going, right? It never satisfies them. It's a validation, right? The more money I make, the more validated I feel. And they can't stop. With Ed Thorp, when it stopped being fun, when the number of things that he had to do in his fund that felt tedious were outweighing, the aspects of it that were fun, it was time to close up shop. It was very clear for Ed that was the end. And then the last thing I want to note here, I really like this. I tweeted this out recently. I think the best we can do as individuals is teach people to think for themselves. Okay? When you begin to think for yourself, the whole world changes and becomes much clearer. You can manage your life much better. I just think that's a beautiful thought. So that's Ed Thorp, guys. I just keep getting more and more fascinated by this guy the more I learn about him. And he's such a breath of fresh air. His thoughts are so kind of clear and concise. There's not all this fluff. When Ed Thorp says something, usually it's something he's thought about a lot, and it just comes through very cleanly from my perspective. So really appreciate Ed Thorp and Tim Ferriss for, connecting with him and interviewing him. Tim always spends a lot of time going through everything that's in the public domain on the people he interviews. So I really enjoyed the questions in this interview. Also very clear and to the point. So kudos to both those guys for a great interview. And hope you guys took something away. I guess my big takeaway from Ed Thorp's interview here is that he just invests in index funds, right? Even a guy who was generating 20% per year for like more than a couple decades is simply investing in the S&P 500. Clearly he has enough money that he can do that and live off that very comfortably. But it does speak volumes about how difficult it is to beat the market by actively picking stocks. So I will leave you guys with that. Thanks for watching. See you all in the next one. Take care.